Gold is rising again, not slowly, not quietly. And this time, it's not just retail investors buying. Central banks are accumulating, institutions are reallocating, and money is moving into gold for reasons most people don't fully understand. This video explains why gold is rising, what's driving demand, and what gold prices are really signaling about the global economy. Gold is not just a commodity, it's a monetary asset. Unlike stocks or real estate, gold does not depend on earnings, cash flow, or economic growth. Gold's value comes from trust and the lack of it. When confidence in currencies, policy, or stability weakens, gold demand rises. That's the first signal. One of the biggest drivers of gold prices is interest rates. When real interest rates fall, cash loses purchasing power, bonds become less attractive, and gold becomes competitive again. Gold doesn't pay interest, but when holding cash costs you money, gold suddenly looks appealing. Markets are increasingly pricing in slower rate hikes, future rate cuts, and lower real yields. That environment historically supports higher gold prices. Gold is priced globally in US dollars. When the dollar weakens, gold becomes cheaper for international buyers, global demand increases, and prices rise. But this move isn't just about the dollar. It's about currency trust. As governments increase debt, spending, and monetary intervention, investors look for assets that are not tied to any single country. Gold fits that role. Continuing our breakdown of why gold is rising. Next up, currency weakness. Gold is priced globally in US dollars. When the dollar weakens, gold becomes cheaper for international buyers. Global demand increases and prices rise. But this move isn't just about the dollar. It's about currency trust. As governments increase debt, spending, and monetary intervention, investors look for assets that are not tied to any single country. Gold fits that role. One of the most important and least discussed drivers of gold's rise is central bank demand. In recent years, central banks have been reducing reliance on reserve currencies and increasing gold holdings. They are diversifying away from geopolitical risk. Central banks don't buy gold for speculation. They buy it for stability. When institutions responsible for monetary systems increase gold exposure, markets pay attention. Final part, risk, uncertainty, and what gold is signaling right now. Gold tends to perform well when markets feel uncertain and volatility increases. Investors seek protection, not growth. This doesn't require a crisis. Gold often rises before stress becomes obvious. It reflects cautious capital, defensive positioning, and risk hedging. Gold is not a bet on disaster. It's a hedge against unpredictability. So what is gold signaling right now? Confidence in fiat currencies is under pressure. Investors are prioritizing preservation over speculation. Institutions are preparing for volatility, not expansion. It doesn't mean stocks must crash. It means money is becoming more selective. Gold doesn't move on headlines. It moves on behavior. When gold rises steadily, it's often signaling caution, not fear. Because gold doesn't tell us what will happen. It tells us how confident the system really is.